Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here with Adrian Nicholson. We're ready for another great episode for you. Adrian, how are you doing?
I'm fantastic, Roshan. It's good to see you. Looking forward to our podcast today. So, all good things going on my end. How about you?
No, everything's going well. I'm looking forward to this one. I'm going to start us off with a Munger quote. This is from Charlie Munger. I believe it is from the 2017 annual meeting, but he's talking about Barron's, which is the financial publication that comes out weekly. I'm going to read it to you. He said, I've read Barron's for 50 years. In 50 years, I found one investment opportunity in Barron's, out of which I made about 80 million for almost no risk. I took the 80 million and gave it to Lee Lu, who turned it into 400 million or 500 million. So I've made 400 or 500 million out of reading Barron's for 50 years and following one idea. I didn't have a lot of ideas. I didn't find them that easily, but I did pounce on one. I think that's a great quote to start us off because today we're going to be reviewing an article that was published in Barron's. That article is titled "12 Stocks to Play: Growing Energy Demand from Oil and Gas to Nuclear and Solar" by Avi Salzman. Now, great time for our disclosure. This is not investment advice. We're merely looking into ideas, trying to give you things that'll help you uh, speed up your research process or give you areas to look into. So, we're not recommending any stocks or securities. Please speak to your financial advisor. If you need help or want to talk to somebody, please reach out to me or to Adrian. All of our contact information is available um, in the bio section in our show notes. So you should be easy to find us. You can also reach out to us or see any previous episodes at our website, retirementlifestyleshow.com. So, Adrian, let's jump right into it. This article was interesting to me because I've been hearing and reading a lot about energy and energy use going up, from electric cars to artificial intelligence. There's a lot of reasons why we're using electricity demand is just increasing, right? So then this article comes out, and I think it was very, very timely, and to give us something to start on. What did you see that stood out to start with, or where would you begin, Adrian?
Yeah, I'll start with a couple things. I guess the first one I'll point out is what they talked about is how energy stocks in general are out of love, where their stock price isn't what it used to be. And I'm not saying that's the case for all of them, but that was kind of the trend. And what you mentioned, now they're starting to be read about more, research and looked into more when you start thinking about energy stocks when it comes to self-driving vehicles, AI, some of the hot topics that our people have been focused a lot on. I think that's just something to make note of and start a discussion where not too long ago, this is kind of like a sleeper sector, like energy is like out of favor. Oh, that's just a place you go to look for income or yield or something like that. You got to look somewhere else like technology or something, where this article is really saying, hey, there might be some opportunities for investors to look at. Don't really ignore that. This might be something where you could find some opportunities. So I think that's just a good place to start and why we're having this conversation today.
Yeah, yeah, I agree. I think that the fact that it is an area that, like you said, is not loved at the moment creates an opportunity. Plus, the tailwinds of increased demand is uh, another area for the opportunity. So what they did at Barron's is they brought in a roundtable of experts via Zoom. The experts were Natasha Kaneva from J.P. Morgan, Stephen Bird from Morgan Stanley, Stan Macher. I hope I got close. I apologize if I got the pronunciation wrong. From Hotchkiss Wiley, and Lucas White from GMO, and they brought in the experts to talk about the field, the space, and the opportunity. So we talked about the increase in demand, and I want to I want to get the right person, but one of the things I pulled was it says that the biggest risk of the world is that balance sheets of producers are not expanding. So producers are, and this was by Stan. nature. And what's essentially happening is demand's going up, but supply is not increasing. And he continues to say that he thinks it's one of the best environments he's seen for the energy space and to invest in the energy space. He cites that balance sheets aren't expanding, meaning that supply is not increasing. Demand is going up, and demand has been flat in this space for a long time in the past. The economy looks fairly good, and you've got a disciplined OPEC, so he views that as a good opportunity to look in this energy space. Any thoughts on that, Adrian?
Yeah, that's just simple econ 101, especially when it comes to commodities in the energy sector. It is driven by supply and demand. And at first, I thought that was surprising when I read the article because they also talked about just geopolitical conflicts as well, with the wars going on in Israel and Ukraine. Typically, you would think that would send, especially oil prices up or just really impact the commodity sector, but that hasn't happened yet. Where right now, what's really impacting them is that supply and demand aspect. How is supply going to be relative to demand? That's what's driving it. And what they go on to say as if these geopolitical conflicts are still contained within their areas, you won't really see a shakeup in these prices where it's just going to be driven by supply and demand. But if it does get worse, if it does start going outside borders, then that's where you could see the risk in these sectors. So this is something that investors need to be on top of and aware of, knowing the potential risk of going into these places for investing.
Yeah, and then when they talk about places for investing, and they definitely do touch on the risk, but the places, uh, they're seeing opportunities in both the fossil fuel and the clean energy space, which
Mm-hmm.
is also interesting to me that both sides appear to be unloved, as you had used the phrase earlier.
Mm-hmm. Yeah, exactly. And this really gets boiled down to, and we'll probably talk about this later because they don't talk about it towards the end of the article. But you tell me when you want to discuss this, though. It really does seem like it's a battle between value and growth, a debate we've had before on the podcast, where if you take out fossil fuels, which has just been a well-established industry that's been around for a long time, where a lot of these companies are focused on cash flow, strong yield, strong balance sheets, repurchase and buybacks, where that can categorize that as the value. Where the growth, where there could be potential, are these clean energy companies whose stock prices have not recovered to what they used to be 3 to 4 years ago, are still burning through capital very quickly. But if they can survive and somehow win contracts and really gain foot, that could be a potential big opportunity. And I'd categorize that as the growth, though. So value and growth is definitely something here where I think that's something that investors have to consider when you're looking at these two different spaces.
And they did ask the panel which side they'd put more money into for investing, and I believe all of them said more in the fossil fuels or existing businesses than the clean businesses. And this might be
Mm-hmm.
the same thing you're saying, just using different terminology. But I'd view it not just as value versus growth, but existing technology versus emerging. Right when I'm and they could really be one and the same as you're saying it. But when I'm looking at this, and as you had said, on one side with the existing businesses, you're looking at companies with mid-teen cash flow yields, as you said, that are doing share buybacks. Whereas on the emerging technology field, one of the data or emerging technology, they're talking about growth. Um, and like you said, signing a big contract. One of the other data points they had in there is that the uh, Wilder Hill Clean Energy Index is down 80% from its February 2021 peak. And you flip that with fossil fuels that are up about 300% in the past 4 years. So even though you've had the growth on what you'd call value, was what I'd call the existing businesses, even though you've had the stock appreciate, they still appear to be cheap. They were just a lot cheaper before. And with the clean energy, the opportunity could be in part that you've had such a big decline in that space.
Mm-hmm. Yeah, and that's where you mentioned it's going to take a lot of research looking into it just to seeing how, if you find an opportunity out there, where going to be the risk associated with it and where it's going to be the upside, and is it worth on taking that investment approach, is going to be, it's going to be big here, because there are going to be winners and losers, and the different environment too are going to impact this as well. I know interest rates too, we talked about it a lot. That's going to be very impactful. If you take, that fossil fuel company that I described as a value company, they can withstand higher rate environments depending on when cuts are going to happen, versus these small clean energy companies who really do thrive on easy capital and lower interest rate environments.
Yeah, well, and those smaller ones, especially with the emerging growth, it comes down to, like you said, their cost of capital, because they're fighting for survival, right? So a lower interest
Yeah.
rate on debt that they can use to expand will give them a longer runway. So just continuing on with some things that really stood out for me. I mentioned this earlier, but just giving the stat that demand's up in electricity by about 2%. And with both the existing, the fossil fuel space and the clean energy space, it says that power generation in the US has shifted away from coal, and it wants to get more towards renewable energy. And there also just is this uh, demand, this power demand that's increasing. Solar power is expected to triple uh, in the US by 2030. So there, there, I mentioned the tailwinds driving this, or that could push this further. You just see usage is up. We're trying to shift into technologies that are cleaner, which are creating opportunities.
Yeah, it's a race to the grid. That's what they were talking about here. And this is probably going to lead us into our AI discussion, how all this ties together. But these big AI companies have these data centers, and they need to get them to the grid as fast as possible to power their huge systems. And that's something too where you have to look at as an investor as well, because some companies are going to capitalize on this, get these AI companies onto the grid faster, win these big contracts, which will help them out. And there's a lot that really gets baked in here as well, where if you talk about just electricity companies getting them onto the grid, there's a lot of rules, regulation, permits that sometimes slow down this race that AI companies really don't like, because again, they just want to be as efficient as quickly as possible just to capitalize on this AI trend, which leads them to look to alternatives. So if these electricity companies can't get to the grid fast enough, they'll look to alternatives. Where one area I think is a big part of this article is talking about looking at nuclear energy now too. That's something that investors are seeing if this is an opportunity.
Yeah, and just like you said it with AI companies, they're trying to get to power quickly, and nuclear may be the answer to them. And you touched on this as well. I just want to go back to it, but you're seeing these AI companies that are building their data centers right near these nuclear plants because of the issue that you had touched on of transmission, needing to
Mm-hmm.
get regulatory approval to in order to transmit this additional power out there. So you've got you've got a bottleneck right there, that these AI, if these companies in the AI space wait till that's resolved, some of the smaller ones could be out of business.
Mm-hmm. Yeah, exactly. And where there might also be an opportunity, which this article touches on as well, as we know, big players in the AI space are these big tech companies out here that are really just taking all these resources, using all this energy up too. So what they're doing too is we have to just look at basically their values and their principles as well, because some of these big tech companies really favor renewable energy companies. So that could be another opportunity as well, where they start using renewable energy projects, and you can see money flowing in that direction too. Another thing too that they touched on as well is the Inflation Reduction Act as well. Now you're starting to see money flow into new renewable energy projects as well, where that's something too investors could look at as well, just seeing where all the money's flowing and seeing if that's an opportunity.
Yeah, the Inflation Reduction Act, coupled with the increasing electricity prices, really do create opportunities in this space in general, but in particular for the clean energy
Hmm.
the businesses. Now, one note they make that I think is very worthwhile to repeat is that you've got to be really careful with the renewables with where you decide to invest. There's a lack of barrier to entries, uh, and so it's easier to get in the space. However, some of them won't survive. So you've got to be really careful, which is why we said this earlier. We're not giving any investment advice. We're just sharing with you what we're looking at in areas we're researching. But that's why doing your homework and doing your research is so important. You've got to find the right ones because there are definitely going to be some of them that will, potentially go out of business.
Yeah, how you invest could be very critical here. If you're thinking, I'm just going to look for individual companies to invest in, that's where your research is going to be the most valuable because, again, you're less diversified if you're investing in a select few of these companies individually. So that's something where you really have to weigh versus somebody that looks for an exchange traded fund or a mutual fund that will heavily diversify them, which, will probably cap your upside because you're so heavily diversified where the individual stocks, if they do well, could be more opportunity. But that's something too that you have to make the decision on when you look into this place, how you're going to structure it.
Yeah, and really a tough call, right? Because like you had said, the ETFs will be a little bit easier. They'll be diversified, and if one company goes under, it's not going to hurt you as much. But your upside, as you said, Adrian, maybe limited, or and not only the upside limited, your risk on the downside. Like they're saying, you've got to look at specific stocks and be careful with what you select in the renewable space. Well, the ETF you select, maybe the criteria they have for the specific stocks don't line up with what you're looking for, and maybe um, they're going to own, maybe they'll own some of the ones that could potentially go under. So I can definitely see positives and negatives to either way going for the stocks versus the ETFs. But I think what this does say is that this is an area where a basket of stocks may be a better opportunity than just one stock in the renewable space.
Yeah, and it's still just very early on to just with the focus on these tech companies and AI and how energy will play a role on it. A couple episodes ago, we talked about the value chain, and we're all the way up on the value chain with this conversation because we're talking about how are these big data centers going to power? How are they going to be efficient? What's the operation? And how much money is going to go where based on what they decide to invest in, whether it's electricity, nuclear, fossil fuels, whatever it may be. And it's still early on, and just to see who the winners or loser are. So that's where it could really drive you on what direction you go when you are looking to invest.
Yeah. Yeah. Another thing that I found very interesting, just one data point, is that it said fossil fuel companies are trading at a 70% discount to the broader market. On average, over the past 100 years, they've traded at a 20% discount over the broader equity market. So, just showing the potential opportunity that's out there.
Yeah, and one of the things they point out too is something that's impacted that number is a lot of like big funds out there, endowment funds, pension funds, depending on what their investment policy is, whether they want to move away from fossil fuels and move into renewable, has impacted these fossil fuel companies as well, where is that something going to change over time or is that trend going to continue? But one of the things that they do mention is compared to renewable energy, like we talked about before, with fossil fuels, their strong cash flow, their yields, their repurchase, their buybacks is something too that may help investors with those returns.
Yeah, and you get the high cash flow, the buybacks, which will then compound the impact because it's like they're putting their cash flow in and buying stock at a good price, and then the earnings per share will go up because they're buying shares, so there are less shares outstanding. So you've got um, a lot of good things happening for that stock price.
Exactly.
So yeah, I definitely see an opportunity. Now, this article goes into 12 different companies, and as those names are coming up, I do go through them and do a really quick review of them. And I came up with three that I think were interesting to research further. and two that I put question marks next to because the numbers don't look as compelling as I would like, but the stories they put behind them are of some interest. I only bring that point up because we talk about this at the beginning, just with our disclosure to people. And Munger said he read Barron's for 50 years and found only one opportunity. It's not something where you read an article and you're like, hey, yeah, I'm going to buy all 12 of these stocks. I view this article as you look at it for ideas, then you narrow down the list further just by a really quick review of the companies, and then when you really research the companies further, you might end up with an investment or none, right? I just want to bring that up because I think if someone might see 12 stocks and then they might go out and buy them, which if that's what you want to do, go for it. It's your money, invest it how you like. I just think you've got to find what fits your investment criteria, and that all 12 of these are probably unlikely to fit your investment criteria. And then when you do decide which of these 12, if any, are worth your additional time, I think that's when you do additional research, and it's not like, hey, I read this and then I go buy it kind of scenario. Just be
Yeah, that's
careful,
a
is
great
what I'm
point.
saying.
Yeah, and I'm excited to hear what your criteria was, what brought these three stocks to your attention, what did you look for in particular. I'm sure our listeners and viewers would just love to hear how your process works when you're kind of vetting these companies from a list.
Yeah, and I don't necessarily want to go in any of the names just because I have not done my homework on them yet, so I don't want to talk about them. But what I'm looking for, and I have, we have previous episodes where we talk about the criteria we're looking for is a good company at a good price. So when I'm looking for first at a good company, and once again, this is just to make the cut for me to spend more time on. I'm looking at things like return on capital, return on equity. And then when I'm looking at good price, it's valuation, price to earnings ratio, PEG ratios, and uh, other valuations, enterprise value to sales and EV to EBITDA, that kind of thing. And then when I start my research after I've looked at those couple things, those couple data points, and I've said, all right, let's look further into it. When I start my research, I'm very much looking for, are these numbers and valuation numbers and profitability numbers, are they sound and accurate? Are they one-time occurrences? And then I'm looking to get what I think would be a good approximation for where the future is going to be for these businesses, because I don't want to just invest based on the past. I want to look towards the future. So when I say there are three that met my criteria, they had good return numbers, return on equity, return on capital, return on asset numbers, and good valuation numbers, meaning low PE, low uh, earnings value to EBITDA type numbers. And once again, those are just my starting points. That's how I eliminated uh, almost 9 out of 12. The reason I say almost is I mentioned I had two with question marks where they didn't meet my numbers, but the story may be worth looking into. So I might spend a little bit time on them. But uh, there are 7 of 12 names where beyond this article, I will probably not spend another moment on today. Who knows what happens in the future, but I won't spend more time on them today. Go
Yeah, and
by today, I
the
mean
first
just in general.
So the first question that comes to mind then with this article, if I can just break it up into two parts, let's just say we have a renewable company and then we have a fossil fuel company. And the renewable company, let's just say it's a smaller company versus the fossil fuel company, which is just a large company. Would the criteria, the ratios, the process you use be very similar? You compare them on both, but let's just say since the renewable company is smaller, you might use something else, compare it to the big one where you'll use other metrics, or are they same for both? It will be equal on both.
At a starting point, it'll be pretty much the same, right? Because I'm trying to manage my time. There's so many investment opportunities out there. I'm trying to make sure that I spend time on what I think will be the most successful, right? So, and to me, what would be the most successful? The ideal company is theoretically something I could hold forever. So if there's something I want to hold forever, it's got to be a good business, which are those return numbers I mentioned, and then it's got to be at a good price, which are those valuation ratios that I mentioned. So that'll go across the board. Where the small companies would be viewed at differently is when I'm doing a deeper dive in the research. And the two names that I mentioned that I had question marks next to are smaller companies, and it's the potential opportunity that's out there that help them make the list. So they're not necessarily meeting my criteria today of a good business at a good price. They're typically meeting one or the other. Like I'm pulling up one of them, and the numbers aren't bad as far as being at a good price. Selling at a relatively low PE ratio, but then the profitability numbers, those return numbers, aren't as high as I would like. And the other name I mentioned, there were two, has got a similar scenario where the profitability numbers aren't as good as I would like, but the valuation is pretty good. So that the reason they are still on the list is because I want to look at, do I think those profitability numbers will be more in line of what I'd like going forward? And that's how the article profiled these companies, saying that they expect them to have good growth opportunities. So that's why they're in there with question marks. The other three meet both criteria. So when I'm looking at my time and where I'd want to spend my research time, it would be the first three that meet both criteria and the other two later.
And would you ever consider, because this seems like a very bottom-up approach where you look at the company and then the top part would be just looking at the overall macro environment. Since it may vary by sector, but since this is the energy sector, do you sometimes take a top to bottom approach where, like we mentioned before, supply and demand is a very significant aspect when it comes to prices for the energy sector, along with geopolitical tensions? So that may say, hey, Roshan, instead of doing this bottom up approach, why don't you start more of a top to down approach on this?
Yeah, I'd say I kind of am doing that, right? Because the whole reason we're looking at this space in general is the increase in demand in electricity, which we anticipate will continue, right? So it's kind of both, right? Top down in the sense that that's what gets me in the space, but then bottom up because I'm looking at specific companies.
That's a great point.
Any other thoughts or questions, Adrian?
I went over everything on my list. Is there anything else that you wanted to review?
No, that's great. I just want to reiterate the words of caution. Do your research, do your homework. I think this is a great starting point, but you've got to look further into the companies. As I imagined before I would make any purchase, it would be probably weeks to months of research in some of these names. And I mentioned there were 5. I'd be surprised if I had to guess. I'd say there'd be 1 to 0 that actually make the cut. But that's what we do. We look for the opportunities and we dig deep. And we'll be back with another great episode for you soon. We hope this was helpful. Take control and achieve your goals.
Schedule a conversation with Roshan, Adrian, or Erik today at retirementlifestyleshow.com. Roshan and Erik are certified financial planner practitioners. They, along with Adrian, are investment advisor representatives and serve clients across the U.S. with financial planning and investment advice through Arete Wealth. If you found this show helpful, gained knowledge, or enjoyed the time you spent with us, tell your friends and leave us a 5-star review. This will help others discover the show. To access our show notes, to download any of the tools mentioned in today's podcast, to ask us a question, or to schedule a conversation, go to retirementlifestyleshow.com. All opinions expressed by podcast hosts and guests are solely their own. While based on information they believe is reliable, neither Arete Wealth nor its affiliates warrants its completeness or accuracy, nor do their opinions reflect the opinion of Arete Wealth. This podcast is for general informational purposes only and should not be regarded as specific advice or recommendations for any individual. Before making any decisions, consult a professional. The show hosts offer investment advice through Arete Wealth Advisors, LLC, an SEC-registered investment advisor, and securities through Arete Wealth Management, LLC, member FINRA, SIPC, and NFA. Finally, our music is The Chance by Jason Shaw and Audionautics. It's part of the YouTube audio library, and it's licensed under a Creative Commons license. I am Ray Voices. Thank you for listening.